Okay, so at the last US Federal Reserve meeting, something really weird happened. First, they dropped their official report. And then the Fed chair himself, Jerome Powell, gets up and gives a press conference. And honestly, it was like they were talking about two completely different economies. This bizarre conflict created a puzzle that, believe it or not, sent the markets absolutely soaring.
So, what is going on here? You've got the official written in stone document saying one thing, and then the guy in charge says the exact opposite just moments later. And look, this isn't some tiny disagreement. This is a massive contradiction coming from the single most powerful financial institution on Earth. So today, we're going to break it down, clue by clue, and figure out what was really happening behind the scenes.
All right, let's put on our detective hats. Our first piece of evidence is that official economic report from the Fed. Now, you got to think of this as the by-the-book Fed. This is the tough, no-nonsense side, the one that is totally focused on crushing inflation. And this report, it was basically glowing, just beaming with optimism.
Just look at this. The Fed cranked up its forecast for economic growth by a lot. I mean, they went from projecting 1.8% growth just a few months ago to a huge 2.3%. Now, in the world of economics, that's not just a little tweak. That's a massive vote of confidence. It's the Fed basically shouting, this economy is a rocket ship.
All of this incredibly strong data was pointing to one single conclusion: the soft landing. And that is the absolute dream scenario. It means the Fed somehow managed to bring down sky-high inflation without sending the economy crashing into a recession. It's like a pilot landing a jumbo jet so smoothly, you don't even feel the wheels touch down. Just perfection. So the main takeaway from our first clue is just total, unshakable confidence. The Fed was so sure that a recession was completely off the table that they literally removed the possibility of negative growth from their models. It's like they found the word recession in their dictionary and just hit delete. The message couldn't have been clearer. Everything is fine. Everything is under control. But just when everybody thought, okay, case closed, Jerome Powell walks up to the microphone for his press conference. And this, my friends, is where the plot absolutely thickens. It's like Powell took that super confident report, crumbled it up, threw it out the window, and gave a speech that sounded completely, and I mean completely different. So instead of doing a victory lap for the strong economy, Powell sounded worried. And his number one concern? It wasn't inflation anymore. Nope. It was the labor market. He started dropping hints that the job market might actually be a whole lot weaker than all the official numbers were making it seem. And then he dropped an absolute bombshell. He suggested, live, on camera, that the official government job reports could be overcounting the number of jobs created by 60,000 every single month. I mean, let that sink in for a second. That's not a rounding error. That's big enough to be the difference between a healthy, growing job market and one that's actually shrinking. Then he did something that, for a Fed chair, is just wild. He essentially told the entire world, hey, you know that official government data that's about to come out? Yeah, don't trust it. This would be like the CEO of Apple telling you their next iPhone sales report might be totally wrong. It just doesn't happen. It was a very clear, very deliberate, and pretty much unprecedented signal. So here's our puzzle laid out plain and simple. On one hand, you have the official document that says the economy is fantastic, we're focused on inflation. But on the other hand, you have the chairman saying, I'm really worried about jobs and we're ready to step in and help if things go south. So which one is it? So how did the market react to this complete and utter confusion? Did they panic? Did they sell everything? Not at all. They went on an insane buying spree. Why? Because they didn't see a contradiction. They saw a hidden message. They saw what they believed was a total win-win situation. This is exactly how investors read the tea leaves. Part one came from the official report. The economy is fundamentally strong, and we're getting that perfect soft landing. And part two, that came from Powell's speech. And if by some chance that strong economy trips and falls, don't you worry, we are standing right here with a giant safety net full of cash. This promise is what Wall Street has a nickname for. They call it the Powell Put. You can think of it like an insurance policy on the entire stock market. It's this core belief that the Fed will always, always step in to stop a major crash. It means heads, you win because the economy is strong. Tails, the Fed bails you out. For an investor, it was pretty much the best news they could have possibly heard. Powell even kind of hinted at the tools he was ready to whip out. He mentioned something called TOMO. Okay, it stands for Temporary Open Market Operations, but just forget the jargon. All you need to know is that it's the Fed's way of injecting a quick shot of cash into the financial system to make sure the gears don't grind to a halt.
Now, it's really important to understand what this is and what it isn't. TOMO is like a temporary painkiller for a headache. It's a quick, targeted fix. It is not the same thing as the big one, quantitative easing, or QE. QE is like major open-heart surgery for the entire economy. So TOMO is a much smaller, much more temporary tool in the toolbox.
So, there we have it. We've solved the puzzle of the mixed signals. The market heard from strong economy with a safety net, and they absolutely loved it. But, cracking this one code just reveals an even bigger, way more complicated puzzle about our future. See, here's the thing. The Fed's entire playbook, all these tools like the Powell Put, TOMO, even the massive QE programs, they were all designed to fight old-school recessions. The kind caused by things we understand, like housing bubbles or banking crises or oil shocks. They're basically set up to fight the last war. Which leaves us with this final massive question. What happens if the next big economic shock doesn't come from Wall Street, but it comes from Silicon Valley? What happens when it's driven by something totally new? Something like widespread job displacement because of AI? Can the tools that were designed for 20th century problems actually solve a 21st century problem? Well, that is the new puzzle, and the answer to that one is going to affect every single one of us.